$250 billion. I'm still trying to process Elon buying his own AI company with his rocket company.
Technically, SpaceX is acquiring xAI, but yes, the corporate governance alone is making my right eye twitch.
Oh, come on, it's brilliant. That single mega deal just dragged the entire first quarter past $1.2 trillion.
Brilliant? Nate, they're just shuffling massive equity around. But fine, let's look at how Sullivan and Cromwell actually structured this beast. The rundown.
So everyone was waiting for the perfect macroeconomic climate. Turns out perfect is a myth. Boardrooms just got tired of sitting on their hands and started writing checks.
$1.2 trillion in Q1 says nobody is waiting for the Fed anymore. Though my absolute favorite part of the data is that North American buyers closed 117 deals and still managed to underperform their market benchmarks.
Ouch.
Just burning cash to stand still. Speaking of burning cash, Intel is buying back that 49% stake in its Ireland fab joint venture.
$14.2 billion.
Yes, which is just wild to me. You spin it out, you bring in partners to share the capital burden, and now you are buying it back? Pick a lane.
I actually disagree on this one. It's a necessary course correction. They need total control over their manufacturing footprint if they're going to compete globally. It's an expensive reversal, sure, but it's a smart long-term play.
I'll believe the long-term play when I see the actual yield rates on those chips. But fine, let's look at healthcare. Danaher is swallowing Masimo for $9.9 billion.
Classic Danaher. Just methodically buying up every medical technology company with a pulse. It's the most boring, almost $10 billion you'll see all week, but they'll probably squeeze incredible margins out of it.
Boring, but profitable. Then you have Antin Infrastructure picking up Sapphire Gas Solutions from Apollo Funds.
Also boring, also highly profitable.
Exactly. Unlike Uber, which is apparently trying to reinvent the black car, they're buying Blacklane.
I love this so much. Uber started by killing the traditional chauffeur service, and now they're just buying a chauffeur service. We've come full circle. You're just ordering a limo again.
The premium pivot. But Nate, the real story in the Q1 data isn't these traditional buyouts. It's the AI deals.
The phantom M&A.
Right. AI-related equity investments made up 29% of total deal volume this quarter. And traditional M&A bankers are absolutely panicking because these aren't outright acquisitions.
Oh, I've gotten the panicked texts. My old banking buddies are terrified. You can't charge traditional advisory fees on massive minority equity stakes.
Good. The traditional buyout model doesn't make sense for AI anyway. You don't buy the whole company, you just buy the compute and the talent.
Well, usually, unless you're Elon Musk. Because we need to talk about the absolute crown jewel of this record-breaking quarter. $250 billion.
The SpaceX and xAI mega deal. The big one.
$250 billion. I keep saying the number out loud just to see if it makes sense.
It doesn't.
No, it really doesn't. SpaceX buying xAI is the exact kind of mega deal that makes my old managing directors physically sweat.
And makes Sullivan and Cromwell's partners buy second yachts. That one transaction alone just crowned them the top advisory firm for Q1.
Q1 was wild across the board, $1.2 trillion globally. We haven't seen this many $10 billion plus mega deals since 2008. But this SpaceX move is the absolute crown jewel, or the giant flashing warning sign, depending on who you ask.
I'm firmly in the warning sign camp. Read the actual structure, Nate. This is an internal shell game. Elon is essentially taking equity from his space company to acquire his own AI company.
Okay, calling it a shell game is a little harsh.
Is it?
Yes, look at the big picture here. You need massive compute for space exploration and autonomous systems. Consolidating xAI into SpaceX puts the smartest engineers under one roof with the deepest pockets. It's vertical integration on steroids.
It's a $250 billion bailout of an AI venture disguised as synergy. Look at the broader market data right now. 29% of total deal volume this quarter is just AI-related equity investments. 29%.
Which completely proves my point. Corporate leaders aren't waiting for perfect macro conditions anymore. They're aggressively locking up AI talent and compute before someone else does.
But they aren't doing traditional acquisitions. That's the gossip I'm hearing from every M&A desk right now. The bankers are scrambling. These are massive equity swaps and strategic investments. Nobody is doing clean buyouts in AI because the valuations are pure fiction.
I will grant you the valuations are frothy.
Frothy? Nate, they're on Mars, which I guess is fitting for SpaceX.
See, that was good, but seriously, even if the price is inflated, the strategic moat is real. Who else can compete with that combined infrastructure?
North American acquirers did 117 deals in Q1 and still managed to underperform their market benchmarks. Boards are already starting to question these aggressive M&A strategies. I need to see the actual revenue projections for xAI before I buy the narrative that this is a genius masterstroke.
You're never going to see those projections, and you know it.
A girl can dream. At least some companies are doing deals with actual physical assets you can touch, like silicon.
Oh, you mean Intel spending $14.2 billion to buy back half of its Ireland fab?
Exactly. I want to know why Pat Gelsinger is suddenly spending massive capital to reverse a joint venture he just put together. Voices. 29%.
It's a massive number.
29% of total deal volume this quarter is just AI-related equity investments. Not buyouts, not mergers, just massive checks being written for equity.
Which is exactly why traditional M&A bankers are crying into their fleece vests right now. You have analysts coming out this morning saying corporate leaders are done waiting for perfect macro conditions. They are getting aggressive.
Aggressive, sure. But they aren't doing traditional deals because they can't. Look at the SpaceX and xAI deal. $250 billion. Sullivan and Cromwell gets the advisory credit, which pushes them to number one for the quarter. But that isn't a standard acquisition. It's a structural workaround to dodge antitrust.
I completely disagree. I don't think it's just a workaround. I think the M&A playbook is actually evolving. You're an acquirer, you want the tech, but you don't want to integrate a bunch of rogue AI researchers into your corporate HR system. You buy a giant stake instead. It's brilliant.
It's reckless. North American acquirers closed 117 deals in Q1 and still underperformed their market benchmarks. Boards are throwing billions at AI out of pure FOMO, and the market is punishing their stock prices for it.
Okay, but we just crossed $1.2 trillion in global Q1 volume. We haven't seen this many $10 billion plus mega deals since 2008. The animal spirits are back, Maya.
Animal spirits usually end up as roadkill. I mean, Intel is spending $14.2 billion just to buy back a 49% stake in its own Ireland fab.
Which is wild. They're basically buying back their own house at a premium.
Exactly. And speaking of regulatory headaches, I want to see if US Bancorp can actually clear these final hurdles for their $1 billion BTIG deal. But first, we need to talk about Uber buying Blacklane. Spill the tea.
I am getting frantic texts from my old managing directors. Total existential panic over these AI equity deals.
Oh, I bet. When 29% of the total deal volume is suddenly just massive equity checks instead of traditional buyouts, the M&A fee pools dry up fast.
Exactly. You look at the SpaceX xAI deal, $250 billion, but it is not a classic acquisition structure. The traditional advisory playbook is totally useless. The bankers are scrambling to figure out how to charge a toll on it.
My tiny violin is playing just for them. But honestly, Nate, the real boardroom panic right now is not the bankers. It is the North American acquirers.
You are looking at the Q1 benchmark data.
I am. 117 deals closed in North America. Massive volume. And they still manage to underperform the broader market. Every single corporate development team is sitting in a conference room right now sweating through their fleece vests.
See, I disagree that it is just a blunder. Corporate leaders finally stopped waiting for perfect macro conditions. They are being aggressive. Sometimes you have to buy the strategic asset even if the immediate market reaction is a yawn.
Aggressive is a very polite word for overpaying. When you do 117 deals and lag the benchmark, that is not a strategic vision. That is a shopping addiction.
Ouch. Okay, fair point. But you know what actually looks like a shopping addiction? Intel dropping $14.2 billion to buy back a 49% stake in its own Ireland fab.
Oh my god, the round trip on that asset is hilarious. They basically pawned it and bought it back.
We definitely need to see who responds to that semiconductor flex tomorrow.
We do, right after we check in on US Bancorp trying to drag that $1 billion BTIG deal across the regulatory finish line. Tomorrow's radar. I am watching the regulatory docket tomorrow for US Bancorp. They are trying to push through that $1 billion BTIG acquisition, and the final hurdles look steep.
I am way more interested in the semiconductor space tomorrow. Intel just dropped $14.2 billion to buy back that Ireland fab stake. You know their competitors are scrambling to respond.
Scrambling? Oh, come on. It is a joint venture buyback, Nate. It is purely defensive. Plus, look at the broader data. North American acquirers closed 117 deals this quarter and still completely underperformed their benchmarks.
Ouch, nothing hurts a managing director's ego quite like executing 100 deals and still losing to a basic index fund.
Exactly. Boardrooms are getting jittery. They are tired of waiting for perfect macro conditions, but they are clearly buying the wrong assets.
Or they are just paying way too much. Speaking of paying too much, we need to talk about Danaher dropping $9.9 billion on Masimo.